This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Get to work. There's one thing the Federal Reserve wants to see before it raises interest rates, and it could appear tomorrow.
Turning point, the Dow Jones Industrial Average suffers its sixth straight loss. Is this the start of a bigger downturn for stocks?
Taking a stand, where the Republican presidential candidates stand on the issues that matter to your money. All that and more tonight on Nightly Business Report for Thursday, August 6th.
Good evening, everyone, and welcome. It is almost here, the monthly jobs report. Before tomorrow's opening bell, Wall Street and Main Street will find out how many jobs the economy created in July and whether the unemployment rate inched higher or lower. The release is a very big deal every month, but this time around, everybody's waiting for it. That's because the first interest rate hike in nearly a decade is on the table. The Federal Reserve Chair has repeatedly said that the central bank is data dependent and that the job market is central to its decision. And as Hampton Pearson reports, the day before the critical report, we got some additional clues as to the health of the American labor market.
One day before the all-important July jobs report, the number of Americans filing first-time unemployment claims rose less than expected, up 3,000 to a seasonally adjusted 270,000. Another sign the labor market is tightening. At the same time, a closely watched report from the private sector shows planned layoffs topped 105,000 last month, a four-year high, with more than half the cuts coming from the military. Last week, the Fed upgraded its assessment of the job market, describing employment gains as solid. A jobs report in line with the consensus forecast for 215,000 new jobs last month and the unemployment rate holding steady at 5.3% could strengthen the hand of market analysts who believe the central bank will raise interest rates for the first time in nearly a decade in September.
What we're really trying to tell clients is, a signal from the Fed that the economy is strong enough to at least move 25 basis points, maybe 50 basis points in 2015 is actually something that's very good. I think not having the Fed move would actually send the signal that, things are worse.
This week, FOMC member Jerome Powell said he would be looking at wage growth as well as total jobs before deciding on what's next for interest rates. Leading market economists believe wages and inflation are the keys to the timing of liftoff. But some of those same analysts say the Fed seems to be in a no-win situation when it comes to market expectations.
The problem will be for the Fed, if the market doesn't think the Fed is going in September, can the Fed convince the market that it's going? Because we're in this bizarro world where the Fed is loath to disappoint the markets of anything.
Tomorrow's jobs report is the first of two that'll be on the desk of monetary policymakers by the time they meet again in September. For Nightly Business Report, I'm Hampton Pearson at the Department of Labor.
The economy may be adding jobs overall, but there is one sector that has been shedding them. As we've been reporting, companies in the energy business have been scaling back, letting go of rig workers as well as engineers. This as oil prices tumble. Today, the pain continued as crude lost another 1% to settle at $44.66 a barrel. As Morgan Brennan reports, the job losses in the energy sector may be far from over.
173,473. That's how many energy-related jobs around the world have been or are in the process of being lost since oil prices began their plunge last fall. Energy consultancy Graves & Company, which has been tracking layoff announcements, says a third of that total has come just in the past 3 months, and that announcements have been coming in waves.
There was a fairly significant wave of service and supply company announcements in late January, February, and early March. We saw additional waves in April with additional announcements by Halliburton and Baker Hughes. And then here recently, just towards the end of July, I think ahead of the earnings announcements, we began to see additional announcements, particularly by E&P companies.
Among the oil and gas producers recently slashing jobs is Chevron, which announced a 1,500-person reduction last week, and Royal Dutch Shell, which disclosed its own additional cuts of 6,500 positions. But no industry has felt the brunt of low energy prices more than oilfield services companies. More than half of the losses to date have been in this sector, including Baker Hughes and Halliburton, which, ahead of their proposed merger, have cut a combined 27,000 positions. double initial estimates. The pain's rippling out to service and support industries as well, with more than 23,000 jobs lost, including at law firms, trucking fleets, and steel factories that manufacture products for drilling. Even railroads have been downsizing as commodity volumes of crude, coal, and metal fall. And it may only get worse.
I think we're likely to see lower levels of prices for a considerable period of time. And there are going to be more layoffs. This will get worse before it gets better.
Graves also maintains his estimates may be low, since some companies are furloughing staff and others are finding ways to simply terminate workers. What we do know is that U.S. employment in the mining sector, which includes oil and gas, has tumbled by 71,000 since December, according to the Labor Department. And tomorrow, when we get the July non-farm payroll report, it's widely expected the sector will log another month of declines. For a Nightly Business Report, I'm Morgan Brennan.
Declines in oil and disappointing earnings weighed on the major averages. Add to that nervousness about tomorrow's jobs report, and the Dow Jones Industrial Average posted its sixth straight day of losses. The blue chip Dow Index closed at its lowest level in 6 months, off 120 points to 17,419. The Nasdaq was hit the hardest, losing more than 1.5% or 83 points, and the S&P 500 lost 16. Courtney Reagan at the New York Stock Exchange takes a closer look at the damage.
Well, it was a red day for stocks nearly across the board. While markets managed to close at least off-session lows, the Dow still finishing at 6-month lows. The Nasdaq, the worst day in about a month or so. Now, there wasn't any one catalyst, no earth-shattering data point, though the market well aware that tomorrow is Jobs Friday. Art Cashin, who is the UBS Director of Floor Operations, says it's largely the overhang from the fast slide in crude oil prices and the associated economic slowdown concerns in China that really has the markets worried. Other traders, though, tell me investors just want less risk. Now, once stocks started to slide in the day, the S&P 500 broke through a key support level, and the selling exacerbated until we saw a moderation about midday. Ultimately, 8 of the 10 major S&P sectors closed lower, with biotech and media stocks among the biggest losers in the session. Biotech is considered a riskier sector, so investors fled today. That, plus some fear that the outperformance in the group may have already run its course. Now, when it comes to media stocks, it really resurfaced concerns this week about the waning power of the bundled services being offered by the big media companies that sent shares of media names tumbling. And because the media stocks are widely held, with Disney in the Dow, Viacom, 21st Century Fox, News Corp, and others in the Nasdaq 100, and all in the S&P 500, the damage was widespread. I'm Courtney Reagan for Nightly Business Report on the floor of the New York Stock Exchange.
Well, earnings have been a major factor in this week's sell-off, and it seems as though the markets are reacting irrationally to seemingly okay quarterly reports. Joining us to talk about what has seemingly become a sensitive market is Michael Farr, President, CEO, Emperor, God King of Farr, Miller in Washington. He's here to discuss these very touchy markets. Michael, there are a couple of things that I notice, and one is this, and I want to ask you what it says about the state of the market. The past few days, there have been some misses or some commentary, and stocks have not just reacted a little, they've reacted a lot. 20% declines, 15% declines, 10% declines. Is this the sign of something, of a market that really wants to turn south?
It certainly feels that way, Tyler. The market has been very unforgiving of any company with a miss. And yet, for the second quarter, 435 companies pretty much beat expectations, it looks like, out of the S&P 500 reporting. Most have beaten their expectations. On the bottom line, the top line, the revenues really aren't growing, and people are concerned. I think investors are concerned about a bunch of things, not the least of which the market has been making new highs for the past few years, and we're coming off those new highs. A lot of the leading industries and a lot of the breadth in the market is contracting. So we've you all have been talking about energy. We also heard that some of the biotechs were down. Some of the industry leaders, some of the tech stocks are beginning to stumble. So where does the leadership come from? Markets are getting a little nervous.
Right. What about guidance, though? It seems as though a number of these stocks that have, in the past couple of days, had the wind taken out of their sails by large percentage moves. It's not necessarily on the bottom line results, but it's the guidance for the rest of the year. Do you agree with that, Michael, or not?
No question about it, and I think that's where we all want to look, because stocks basically are forward pricing mechanisms. And yes, the guidance is very important, and the guidance from all of these companies is pretty much things don't look great out there from these CEOs and CFOs who are taking a look at the prospects for their companies and operations and sales in the U.S. and across global economies. So the weakness in China and other parts around the world are having an effect and we're seeing things, I guess, just contract a bit, expectations lower, and stock prices are showing it.
We see what you see in terms of the earnings per share numbers. Those numbers can be tweaked and maneuvered. Revenue is a much harder thing to tweak and maneuver, as you point out. So what should I do with my money in this environment, Michael?
Right. Tyler, I think first, you don't panic. Well, if you're going to panic, be the first one to panic. Otherwise, it's way too late for everybody.
Otherwise, it's too late.
But don't panic. Markets do this. We haven't seen a 10% correction in a few years. Last October was as close as we got, and it came close. And then Jim Bullard from the St. Louis Fed came out and said maybe the Fed had to do more, and stocks went back up. So we're due for a correction. You typically don't get a huge correction when everybody's out there wringing their hands saying, gee, the stock market's getting ready to collapse. When they say it's ready to collapse, it's not ready to collapse. So probably going to have a pullback. There will probably be a buying opportunity. Rates look like they're going to be low for a while. Commodity prices low for a while. So keep some dry powder. Be cautious, but make darn sure you know what you own and why you own it.
All right, Michael, perfect advice to end on there. Michael Farr, President and CEO of Farr Miller in Washington.
Thanks.
It's been a tough week for a number of IPOs, but today it wasn't all bad. Immune Therapeutics, which is a biotech company, priced at the high end of its range, and its shares rose in its first day of trading. The CEO says his company is making a big investment in developing treatments for peanut allergies.
We're trying to make kids and adults safe from accidental exposure to peanut protein. And this is a treatment that gradually over time you build up their level of desensitization so that they can tolerate the kind of levels they'd see in an accidental exposure.
Planet Fitness also made its debut, and it was a disappointing one. Despite the uninspiring start, though, the CEO remains optimistic.
No, our unit economics are very strong in our model, and the franchisees are very bullish on the concept, and they keep building more stores. I mean, interesting, so last year, 87% of our new units opened were by existing franchisees. So they're putting the money back into our system and building stores faster because they're happy with the returns.
Shares of Immune Therapeutics rose 50%. Planet Fitness, after starting lower, then gaining ground, ended pretty much flat.
Still ahead, debate night in Cleveland, where the Republican and presidential hopefuls stand on things like taxes, entitlements, and the fast-changing job market. We'll tell you. Activist investor has taken aim at a major food company. Bill Ackman has built a $5.5 billion stake in Mondelez, the maker of Ritz crackers, Oreos, other popular snack foods. His investment comes as the food industry undergoes a transformation and tries to deal with changing consumer tastes and slowing growth. Many speculate that Ackman's investment could make Mondelez a takeover target, and that sent the stock higher today, even as the broader market declined.
Russia has launched a sophisticated cyber attack against the Pentagon. As first reported by NBC News, the hackers got into the Pentagon's Joint Staff Unclassified Email system. The attack occurred sometime around July 25th and affected about 4,000 personnel. The system has since been shut down and taken offline.
A San Francisco judge hearing arguments today in a case against Uber. The debate centers around their workers and whether they should be classified as independent contractors, as they are today, or as employees. May not sound like a big difference, but as Kate Rogers tells us, the ruling could have major implications not just for Uber, but for other companies as well.
Outside of a San Francisco courthouse, Uber's attorney is defending the company's model of classifying its drivers as independent contractors.
If the class went forward and they prevailed, one of the devastating consequences would be to the drivers, who then wouldn't be able to work on flexible schedules. They would be on fixed wages. They wouldn't be able to be entrepreneurs, setting their own schedules, driving when they want, which is really the essence of what so many of the drivers say they love about Uber.
The scope of a lawsuit against Uber stands to impact the sharing economy in a major way. Many startups in the space rely on the independent contractor model as a way to pare down their costs. Other companies, including Washio, Handy, Instacart, Caviar, and Postmates, have been hit with similar lawsuits. Homejoy, a startup that connects cleaners with projects, just recently folded on July 31st, citing a pending lawsuit against the company as one of the reasons it was unable to raise capital. One of the big questions that remains in the Uber case is how much it could cost the company to reclassify its workers as employees. Now, Recode estimates it could cost Uber upwards of $209 million, including workers' compensation and unemployment insurance. Now, that number does not include gas and mileage reimbursement, which are two of the things plaintiffs are seeking in the case. The employee versus independent contractor debate has regulators across the country fired up.
We all want to make sure that these workers are treated fairly and compensated fairly and have the same social safety net as other workers, and we need to do it in a way that allows innovation to occur.
Even 2016 contenders like Jeb Bush and Hillary Clinton have entered the fray to weigh in on the gig economy.
I'll crack down on bosses who exploit employees by misclassifying them as contractors or even steal their wages.
Jeb's response, of course, was to hail an Uber. For Nightly Business Report, I'm Kate Rogers.
The so-called gig economy and the changing labor market could be a hot topic at tonight's first Republican debate, along with other issues important to you and your money. John Harwood is there. He's in Cleveland at the site of tonight's debate. Good to see you, John. So when it comes to the new way that people are working and employee protections that we've just discussed here, Uber is one example, certainly. Where do the candidates stand on that?
Well, I'd expect all the candidates to say, as Marco Rubio said when Hillary Clinton criticized aspects of the gig economy, that this is 20th century economics. We need to move to the 21st century. We need to embrace these new forms of work, the sharing economy, as a way to enhance future prosperity. So the argument's going to be engaged there. I wouldn't expect them to differ much with one another.
Let's talk taxes. Ms. Clinton out with her plan on capital gains taxes 10 days or so ago. What can we expect to hear tonight from the candidates on the GOP side?
Well, there's broad agreement, Tyler, on tax policy on Republicans. They want them lower. They're not going to be for Hillary Clinton's plan, but there are variations within the field. You've got some people, Ben Carson, Ted Cruz, who are talking flat tax. You've got other people, Chris Christie, Marco Rubio, who are talking lower rates. And Donald Trump, the leader in the polls, he's been all over the map. In the past, he's been for a wealth tax, which would be very large. But lately, he's been talking flat tax himself, so they'll get a chance to lay those out tonight.
One hot button issue is likely to be entitlements. So what kind of reforms might the candidates propose tonight?
Well, that's another example. You've got people like Jeb Bush and Chris Christie talking about raising the retirement age. Chris Christie's talking about eliminating benefits for people with incomes over $200,000. But Mike Huckabee, populist former governor of Arkansas, has said, no, don't go after Social Security. Donald Trump says, no, don't go after Social Security. Politicians only do that because they don't know how to grow the economy. I will.
Let's talk about their records on the economy. Several of the men on stage tonight have been governors of states. We can look at job growth state by state and see who did well and who didn't, among other numbers. How do they rank?
You can expect to see governors trade barbs about their records. The one with the best economic record, Rick Perry, was in the first debate tonight. But the governor-legislator divide will be big. And, of course, there's one candidate who doesn't have a record, which gives him the freedom to claim that he's going to do great things. That's Donald Trump.
It's going to be fascinating. John, thank you very much. John Harwood in Cleveland.
Shares of Michael Kors surge on an earnings beat, and that is where we begin tonight's market focus. The handbag maker managed to post results that trumped, no Donald, estimates on both the top and bottom lines. Its full-year guidance also came in above consensus. Profit did fall for the second straight quarter, but investors overlooked that and sent shares up 11% to $43.77. Brinker International, the parent company of the restaurant Chili's, posted disappointing quarterlies. Revenue rose but missed its own estimates because of weaker sales. Shares were off nearly 5% today to 56.48. And Molson Coors brewed up a beat on the bottom line, but sales weren't so bubbly. Below analyst estimates, cost-cutting and demand for higher margin beers did help the firm's results, however. Shares were up almost 5% to 73.65. Meanwhile, shares of Generac went the other way. They tumbled after its earnings and revenue came in well below estimates. The maker of power generators blamed the miss on a record low level of power outages. The stock was off 14% to $29.10.
The New York Times saw its earnings rise nearly 80% after it cut operating costs, but revenue was off because of weak advertising sales. That sent shares down 3% to $12.80. Costco reporting same-store sales that were flat in July, but that's better than the drop-off that Wall Street was expecting from the wholesaler. Still, shares were off slightly to $146.44. Dow component IBM is buying the medical image company Merge Healthcare in a deal worth $1 billion. The firm will combine with Big Blue's new health analytics unit. Shares of IBM fell less than 1% to $156.32. Merge surged over 31% to finish at $7.10. Coming up, as more companies offer more perks for employees, are they raising the bar? And will it change the workplace as we know it? Some sobering statistics for the nation's heartland. Farmland values grew at the slowest pace in about 5 years, with the Corn Belt region seeing declines. The Department of Agriculture says the average value of cropland in the Corn Belt, which includes Illinois, Indiana, Iowa, Missouri, and Ohio, fell more than 2% from a year ago. The drop reflects both lower corn and soybean prices.
As we told you last night, Netflix announced an employee benefit that's generating a lot of buzz, allowing new parents to take an unlimited amount of parental time off at full pay in the first year after the birth or adoption of a child. Perks have become the norm, that have become the norm in Silicon Valley, though, aren't the norm in the rest of the country. So are catered lunches and unlimited vacation days at tech companies, making it hard for other businesses to compete for talent. Jacob Morgan is an expert on the subject and advises some of the biggest companies in the world on the evolving workplace. He joins us now. Mr. Morgan, welcome. Good to have you with us. I'm very interested in this topic, very interested in what Netflix did. But you tell me, are benefits at large corporations getting better overall or worse?
Well, I think what we're starting to see is a shift for organizations to focus on the overall employee experience. Benefits are, of course, a part of that, so I think we're going to start to see them actually improve.
It also depends on what the company does it not? I mean, you've made the point that maybe in Silicon Valley, they produce something different than, say, General Motors does or IBM does. And so, therefore, the work experience for the workers that work for a traditional company might be quite different than those that work for a cutting-edge California, Silicon Valley company.
Oh, absolutely. I mean, I think the biggest thing that organizations around the world can take from this is that they should be listening to their employees and treating their organizations more like laboratories and less like factories. So it's testing ideas and figuring out what makes sense for your company and not necessarily trying to copy what everybody else is doing.
I wonder, Jacob, whether some companies are substituting lower cost frills, like unlimited lattes and M&Ms at the company canteen, in place of more expensive traditional benefits like defined benefit pensions and like more lavish, less employee costly medical plans.
Well, when we think about the employee experience, there are three environments that companies have to think about. There's the digital environment, the physical environment, and the cultural environment. So I think those are the three areas that companies are investing in. Of course, there's no substitute for pay, but a lot of the organizations that I speak with and a lot of the employees that I speak with are actually willing to take a pay cut in order to get some of these other things.
So how competitive is it going to become for more traditional companies that perhaps have not had to look at the overall employee experience as they compete with companies that are trying to lure millennials and people who care more about the total experience?
I think we are moving towards a world where the war for talent has never been more fierce. I think that as we continue to move forward the next 3 to 5 years, we're going to see unbelievable battles and wars for talent, unlike the business world has ever seen before.
Jacob, thank you very much for your insights tonight. We appreciate it. Jacob Morgan, author
Thank you for having me.
The Future of Work.
And finally tonight, the Super Bowl may still be 6 months away, but a record has already been broken. CBS's CEO says a 30-second ad is selling for as much as $5 million. And that figure easily beats the prior record of $4.5 million. Ad prices have gone up right along with viewership. The Super Bowl earlier this year had the largest audience in history, and that is why marketers are willing to pay so very much for an ad.
And it was a great game.
And it was a great game. It really was. It was a lot of fun, and those ads are great to watch. Yeah. That does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and we'll hope to see you right back here tomorrow night.